Today on the show, Brent calls in to ask about rental car insurance, what is useful and what is redundant. Sherry writes in to discuss not first, second, or third, but fourth generation FI and how she and her family have transformed their financial ground game over the last year. Finally, we get a chance to bring Chris on the show to talk about a really cool topic, the family bank. And honestly, this is an excuse for us to introduce a new segment called Let Me Run It by My Accountant. Welcome to the ultimate crowdsourced personal finance show. This is your Friday Roundup.
You're listening to ChooseFI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. ChooseFI, your home for financial independence online.
All right, guys, it's going to be a lot of fun. Got a lot of great topics planned for today and can't wait to talk about this past week's episode with Robert, the college investor. To help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I'm doing quite well. Yeah, what's going on by you?
I think the biggest thing is that I've been taking a hard look at what I want to explore in terms of my own talent stack right now. So with ChooseFI, there's an endless number of kind of little technical things that I can dig into. And that's gratifying to a degree, but I find myself wanting to pursue a skill set that does not tether me to the computer, that would maybe have me working on something that is a little bit more physical. And so working out has done that to a varying degree, but I'm exploring a little bit of woodworking right now. And so I'm actually planning on tackling my first very, very small and unambitious, uninspired woodworking project. So I'm actually Googling what can I do with the very limited tools that I have. And I will kind of keep you guys updated. But, I think it's one of these interesting things that you can do anything, but not everything. And we've talked a little bit about the hobby checkboxes and how to find something. But with that in mind, I'm kind of like myself, just going through this. What is it that I want to pour all my energy into?
Yeah, I've been thinking about this lately too, because I don't know, I feel like I'm kind of all over the place and I'm not really putting in that deep work, to quote Cal Newport from his book. I definitely feel a little scatterbrained at times, and it's not satisfying. So I'm with you there. What are you contemplating now?
I'm trying to tie a couple things together. So I'm living a little bit more of a simple existence. You've kind of heard about some of that simple living techniques come through, and I'm exploring composting and gardening. I think my kind of DIY bug would feed into this. So I'm thinking about building a raised garden bed, and that being my very first project, which then will be something that I can do with my wife. She can be my helper and we can kind of measure all this stuff out and do all of our cuts together and then assemble it all and see how it goes and then kind of use that to get us more active in our garden. So I think that's where this is headed, but I'm kind of pursuing this with an open mind, and that really at this point, I could pick up any hobby I want. What do I want to do?
Yeah, it's funny because I literally just got back from CrossFit a few minutes before we started this recording here. And I had a really deep conversation with the coach who's actually the owner of the CrossFit that I go to. And it was about my goals at CrossFit. But to me, it's kind of like a larger theme about my entire life. And it's, what do you want to do? What do you want to get out of this? And that was his challenge to me. I've been improving, certainly, like in the year that I've gone to CrossFit, but I think there's something holding me back. That was his challenge to me, is I have these little nagging injuries, but his question was, do you think it's physical or is it mental? And if it's mental, what is it? And I don't know, just the last hour, I've really been trying to think about this. And I think it is partially mental. I think it's a bit overwhelming to walk into CrossFit. And please, for the audience, this is not about CrossFit. This is about anything that you want to master in life or pursue. When you look at something like this CrossFit, for instance, there are hundreds of different little skills that I can work on. And when I look at it in totality, it is this massive and massively frustrating set of problems almost, because you can't get good at everything. So to me, it's more like an 80-20 analysis of, if I worked on these couple of things, would they help everything else get better? That's kind of what I've hit on. And granted, this is only an hour post this conversation, so I need to really ruminate on it some more. But I think that's where I am. And to me, it's overall level of fitness. So that might mean doing like significant conditioning as opposed to working on the intricacies of the hang squat clean or something random like that. Why not get on the rowing machine and do interval training or do sprint intervals up at the track? I think that would be the key to unlock maybe my own mind. So that's kind of where I am. And I think that is relatable for people in pretty much anything you're pursuing. What are those couple things, A, that are holding you back, but B, that could unlock success by just doing these couple of things? Does that resonate with you, Jonathan?
Oh, it really does. And actually, something you said, you mentioned a book in there, Deep Work by Cal Newport. And I think it's close to the 5th time that I've heard it referenced, and I have not yet picked it up. Like, is that a book that you would recommend?
Yeah, it absolutely is. Way too long, certainly, to give a synopsis here, but I think it really focuses on diving into things and taking that time to focus as opposed to being like, as Tim Ferriss would call himself, like a professional dilettante and like just going an inch deep and a mile wide. And I think I often do not go that deep into specific topics. And I think that's benefits me in some regards in that I know a good bit about a lot of things, but it's also a detriment because there's never that time that I just carve out for that thinking and putting everything else down, shutting everything else off, and just really diving into something. So I think there's clearly benefit to both, but just like anything in life, when you focus on one at the expense of the other, there's always something lacking. So I think for every single person, there's going to be a path forward based on your interests, your skill sets, et cetera. But it's important to have a little bit of everything.
It's kind of sad how much that term professional dilettante actually resonated with me. I was like, oh, I belong. That's me. That's what I do. I will say that I have been incredibly good at going deep on production quality type things. So focusing on the production quality of the podcast, focusing on the website, and honestly, little things that no one would ever consider, like learning how to use Photoshop and video editing and After Effects. And I will spend days and weeks learning the smallest little technique because it's fun to be able to almost immediately put them to use in the context of this little business that we have. I mean, I enjoy that. It feeds into something. And so I've gone actually really, really deep into these topics, but I think it's kind of like a crutch that all of my hobbies involve a computer. Like I just, at some level, I'm like, you need a physical skill set it would be nice to balance this out and have you spending an equal amount of time on something that doesn't have an LCD screen or an LED screen.
I totally hear you.
But when it comes to enthusiasm, I think I found a kindred spirit when it comes to Robert, the college investor. This was a guy that I just love the enthusiasm he brought to this past episode. And I love his story, his origin story. It really was incredible. It's absolutely the first person that has kind of walked us through this very traditional yet overlooked segment of our economy, retail, and showed us a very clear way to reach a far beyond the median income salary and essentially reach financial independence through that vehicle alone.
Yeah, that was very impressive. And a world that I just know nothing about, retail. But to imagine that he was making $180,000 as a Target store manager. And he said that's pretty standard for across the country. That was impressive in and of itself. But I love how he described his hobby as, quote, making money. That was kind of a cool take. He enjoys building businesses and the game of it all. Of course, the origin story of going back to selling candy bars in middle school. It's so interesting that a couple of our guests have stories like that. It really is kind of cool to go back to, like you said, that origin.
Well, in sidebar here, you were posing the question in that particular episode. I wonder how many of those kids that figured out a little side hustle in middle school are now millionaires. We kind of had to bypass it. There's no way for us with our small little budget to go and do some sort of, I guess it would be survey or census, if you will. But I think it really would be remarkable if your hobby from a young age is figuring out different ways of making money. We talked about deep work a second ago. There's another book. Is it called 10,000 Hours by Malcolm Gladwell? Is that the one, Brad?
Yeah, I think that was actually Outliers,
Yes.
where, yeah, the name of the book was Outliers. And he discussed that principle that has commonly become known as the 10,000 hour rule.
So the idea being, if you're willing to put 10,000 hours into anything, by the end of that, you are going to be good at it. You may not be like in the top 1%, but you're going to be better than the vast majority of the population. So what if you start that 10,000 hours as a child, as an 8-year-old? What if you start pursuing this hobby of making money? You're going to be very good at making money by the age of 30. You're going to have put that time in. And so he gamified this at a young age. And I think a common theme that we see and we will continue to see is that with the entrepreneur, it's not the idea, it's the mindset. The idea isn't as important. It's a framework at looking at the problem.
Right. I mean, he's not going to reach FI selling candy bars that he bought at Costco. But
well, he could have if his principal hadn't shut him down. Scaling was the problem, man.
But for a 11-year-old kid, selling candy bars over and over again, that sure feels like FI, right? He probably had hundreds of dollars that he earned from this, and he's rolling in dough at that point. It's just an impressive mindset that he was thinking then. And then to get this job at 16 years old at Target, where incredibly he worked there for 17 years, Jonathan. I've never heard of that. And I mean, he started at the lowest level, cart boy, cashier, and he worked himself up to getting an MBA and becoming a store manager, making $180K. I mean, that's a pretty cool story.
Normally, Brad, I would actually agree with you. But when I think about my trips to Costco, and Costco is kind of one of these stores that we go to at least every 2 weeks, when I look at the employees on their name tag, it actually says how long have they been working there. And it seems like every single time I take the extra second to notice, it says an employee at Costco since 1988. I mean, it's something absurdly long. I guess in my mind, that really speaks to the quality of the company and how they treat their employees. If your employees wear as badge of honors how long they have actually been there, it really, really is incredible. But aside from that, I think as we look at the economics, this is a real opportunity. There are a lot of retail jobs. And if you combine a willingness to stay with a company for a long period of time, you tether that to a willingness to move, you can very, very quickly go up the ranks. So I'm just let's lay this out real quick. There are tons of these types of jobs. So it's not just Target. Target's not the only one that has store managers that are making over 6 figures. There would be, the one right across the street. There's going to be grocery stores. There's going to be food stores in Long Island, right? There are a ton. Retail is a massive, massive sector. The primary qualification is leadership skills, people skills. He said, you can teach people how to do math, but you can't. It's very hard to find people that are friendly and have good customer service and communicate. That is a soft skill, right? If you're willing to be that person, and you're willing to position yourself, and then on top of that, you're willing to move where a company needs you, I would say that you virtually have this thing locked down. And the other thing that was cool about this is the degree, more so with this than anything that we've talked about up to this point. You may want to have one, but it is absolutely, definitively from Robert, it is a check the box. After you have 1 year of experience, they could care less. And that translates far outside of retail, but it certainly was interesting to hear him as someone who is on the inside at the highest level, someone really state that publicly.
Yeah, and I thought there were some cool actionable takeaways from his talk about college, just generally, which was first, see if your company has tuition reimbursement. I guess he said he got it for some of his undergrad and some of his master's or MBA degree. I mean, that is free money. So if your company offers it, if you're going to school while you're still employed and your company offers it, please take advantage of it. It can be big bucks. Obviously, that's not going to pay for the entirety of your school, but it's like getting a grant in essence. It's free. So that in and of itself is a great actionable takeaway. And then, yeah, where he's saying college is a check the box. That stuck out to me. So in this particular case, and now that is not going to be the case if you're going to a top tier law school or you're looking to get a job at Goldman Sachs right out of undergrad, they're not going to treat the person going to Harvard and Stanford the same as University of Phoenix. It's just, that's the way the world works. But hey, if you want to get a job as a Target store manager, or like you said, Jonathan, any of these other major retailers, well, Robert is saying directly, as someone who has hired 1,000 people, It really is. It's just about that piece of paper. And now obviously that speaks societally to like, what are we really doing here? But that's like
much larger societal issues. But what about that phrase overeducated and underexperienced? I know we both wrote that down. I think the millennial generation, which I think, buddy, you may have just slipped out of, the millennial generation is the most overeducated, underexperienced generation in history.
Yeah, it is like this financial death spiral because not only do you have loans from undergrad, but then you're going straight into some graduate program and just furthering the opportunity cost, right? So it's extra years out of your life that you're earning nothing and you're spending all this money for graduate school. And then like he said, you still have to start at a beginner's job. So unless it's absolutely 100% necessary, unless it's imperative for this dream job that you want, maybe it's a good plan to get some work experience, right? Because as Robert described it, I think he said something like 18 months. Past the first 18 months, your degree is irrelevant, right? You don't even think about it. And we saw this with Jay from Fire Drill and Millennial Boss. I mean, she basically scrapped her entire resume fairly quickly after realizing, oh, you mean all those things I worked for all those years? Nobody cares? Well, what they do care about is, what have I created? She created this blog and she worked on this other travel site and she created a gifted and talented program. That actually mattered. And I think we just need to reframe this, right? So the overeducated and underexperienced, that's a quote to remember for sure.
Put it in the lexicon.
Yeah, and Robert had a couple of interesting quotes that I thought were worth reiterating here. And it's about college, but it's about people. And I think that's the most important thing is he said, college can teach you some skills, but it doesn't teach you communication skills. It doesn't teach you on-the-job problem-solving skills. And those are the two things that he thinks make someone successful at their job. That really, what are you going to do in an uncertain situation? Can you look back to some textbook? No, you need to have the ability to figure it out. You need to be able to problem solve and you need to communicate. He said what he looks for in an interview, are you friendly? Are you nice? Can you look me in the eye? And he said he cannot teach someone to be a nice person or friendly. So that's what he looks for. He's selecting for that because especially in his line of work in this retail, he said he can teach people pretty much anything, that the actual skills of the job are not that difficult. But if you have someone who cannot relate to other human beings, then they're not going to be great on the floor of a Target. So I think that is a larger lesson for life is just be a nice human being. Be friendly. Try to be relatable. It's just so important. I mean, in everyday interactions, when you call someone up and you call up an 800 number to, I don't know, deal with some customer service issue, do you really think that being a jerk is going to help you in that situation? This is a question I would pose to everyone listening to this podcast. Do you really think that's going to help you? No, of course not. Being a nice, normal human being, asking questions, saying thank you, saying I appreciate your time, just little things, even if deep down you don't mean it, even if you're just some weirdo and you can't even be nice, just say it anyway. They deal with mean, boorish people all day, and just being compassionate and being a human being can just get you so much further in life. So fake it until you make it. Even if that doesn't come naturally to you, just try. You'll be surprised at how much better the world is for you when you adopt that positive mindset and you actually appreciate people and show some gratitude. I think that is a big takeaway that I've just figured out in life in the last couple of years, because not that I was some jerk, certainly growing up, but and I didn't berate people. I don't want anybody to get the wrong idea here, but I've gone out of my way to just be appreciative of people. And I think in some weird cosmic way, the world is rewarding me, but it's not so weird. I'm saying that jokingly, like people want to be nice to you when you're nice to them. So this kind of all relates back to what Robert's saying about just be friendly, look me in the eye, and be a nice, normal person.
And Brad, this actually, talking about college in terms of ROI, this reminds me so much of a message or a comment that we got from Tom in our local group here in Richmond. He was sharing with us. He had heard about this Virginia college hack from a friend at church. His son is in Henrico's Advanced College Academy. This program gets you the associate's degree from J. Sargent Reynolds, a local community college here in Richmond. And it also gets you automatic admission. All of this happens by the time that you graduate from high school, completely free. So you actually get your 2-year college degree while you're in high school. And Stacy piped up on this and was chipping in and mentioned that this is actually a goal for my county, for Chesterfield County. They're making it a goal for high school students to graduate with your associate's degree. This is ROI. This is what it looks like. And if you don't have this at your high school, I wonder what it would look like to be an advocate for this type of program. Because if a school here in Chesterfield is able to pull this off, we're not exactly the most progressive county. You would think that this would be something that you could replicate anywhere else if you had a group of people that realize the power of ROI, that put the emphasis on making it happen. College is broken. What would it look like to fix it? I think it's to get more for that same amount of time that you're putting in high school.
Yeah, that's really interesting, Jonathan. It would be neat to see them pop up all over the country. So we'll certainly stay tuned.
All right, let's go ahead and crowdsource the remainder of the show. And I thought we could start by playing a voicemail that we got from Brent. And he called in to ask about rental car insurance.
Hey, Brad and Jonathan, this is Brent from upstate New York. I'm hoping that you or perhaps someone from the community can demystify rental car insurance for your listeners. I travel a fair amount and rent cars every so often, and I'm always unsure whether or not I need to add on those supplemental insurances. Typically, I'm using a credit card to rent. Usually this is the ChooseFI Reserve, which I know has some protections built into it. I also have a primary auto policy through Travelers, which I believe has protections built into it as well. But I'm wondering if you could help sort of explain, the different types of protections that the rental car companies offer and when these might be redundant. So what am I looking for in my primary policy? What am I looking for within my credit card protections? Much appreciated.
Yeah, Brent, that is a great question. The credit cards that jump to mind that offer protection for rental cars are, like you said, the Chase Sapphire Preferred and the Chase Sapphire Reserve. Those are two premium cards that we highly recommend for travel rewards purposes. But yeah, one of their secondary benefits are rental car insurance.
Yeah, and I would add on to that that you never want to wait till you're there in line at Hertz or Enterprise and they're asking you whether or not you want rental coverage to know what your plan is, like deer in the headlights. They're going to get you. It's built into their pitch. I'm sure that if you were to peel back the hood and look at their performance incentives and bonus structure, like they make money when you select some of these additional features like rental coverage. Now, you need to have coverage, but the likelihood is that you already have it, and it's not in their best interest for you to know that. So go into a rental car situation prepared. The most obvious ones, the easiest ones are if you have one of these primary cards, they offer some additional benefits. Like Brad said, the Sapphire Preferred and the Reserve. I was reading an article that was released earlier this year on creditcards.com, dated January 22nd, 2018, that also mentioned that the United cards were on there as well, the Mileage Plus Explorer and Mileage Plus Club cards. Also, the Ritz-Carlton Visa and the JP Morgan Reserve cards, which I don't have any of those. But going back to how to activate those benefits, in order for your credit card coverage to kick in, you need to, one, decline the rental company's collision damage waiver, and you need to be the primary renter of the car. So if you're getting it, but the card's in your name, but it's actually going to be your spouse driving it or something like that, that's going to be a problem. And then finally, the third piece of that is pay for the car in full with the card that provides the protection. So those would be the keynotes. Also, the other thing is, for those of you that don't have any of these cards, the other piece of that is, well, do I get these benefits with my primary insurance? And so my takeaway here is, so I have USAA auto insurance, and they absolutely do cover rental insurance for your car. So call your insurance company. That would be your action point. Call your insurance company and find out whether or not your primary auto insurance extends to rentals and what you would need to do to activate that. In many cases, it's just kind of done for you behind the scenes, but it'd be nice to have your auto insurance basically give you that confirmation. And then also be aware that collision and comprehensive coverage may not pay for every charge. So again, when you're talking with your insurance company, just find out what is covered and what isn't covered. Final little housekeeping point from your friends at ChooseFI. This is just something that I do each time. When I get that rental car, before I hop in and drive off, I just do one walk around the rental car and just take a picture of it, especially if there's any scratches or dents or anything else. You just want documentation with that timestamp of what condition the car was in before you got it. The worst thing ever would be to, pick up a car that has a dent in it, drive it back with said dent, and then as you're leaving, they say, well, you brought it back scratched. And you're like, well, no, I didn't, but I don't have any way of proving that. So a little public service announcement there.
Yeah, and Jonathan, I think getting in touch with your car insurance for your primary car, I think that is probably the answer, just to have some certainty here. And I went to Geico's website and there was an article that says, does your car insurance cover rental cars? And they said, the answer is it depends. The first step is to check your auto insurance policy to see what type of coverage for rental cars may already be included in your personal auto insurance. If you carry comprehensive and liability coverage on your personal car, coverage typically will extend to your rental car. If you're renting a car of similar value to your personal car, in all likelihood, the insurance coverage will be adequate for the rental. And they go on to say you should also check with the credit card company, which is, again, what we said, the credit card that you'll be using for your car rental. If there are any gaps in coverage with your personal auto policy, the credit card company could provide secondary coverage. So just like anything in life, it's do your research. Just make these 2 quick calls, and then you know forever. There's no uncertainty when you show up at the rental car company. You have the credit card you're going to use, and you know if your auto insurance policy does or does not cover this. So I think, yeah, that's the answer. It's a great question, though. Thank you.
All right, now I got another email that I wanted to share with you guys today, and this came from Sherry. And she says, I have just taken my first trip on Travel Rewards and was in the process of crushing my grocery budget when a good friend introduced me to the ChooseFI podcast earlier this year. Aside from our mortgage, my husband and I have been debt-free for several years. Before being introduced to the podcast, we had 3 401k accounts, 2 of which were eligible for rollover, a taxable brokerage account, and several savings accounts. I was contributing 13% to my employer-sponsored 401k plan. Since starting his job 2.5 years ago, my husband was turned off and not contributing to his 401k because his coworkers grumbled that there wasn't an employer match. I have a savings account for just about everything, yet we didn't have a high savings rate. And yikes, we've been paying 2% on our taxable brokerage account. I always believed there was more I could do for our financial well-being, but was clueless on how to go about it. By the way, let me mention that I have always loathed taxes and dealing with investments. Then I was introduced to your podcast. I have been hanging on every word, and J.L. Collins' Simple Path to Wealth is a page turner. I can't believe I just said that. It was such an easy read and provided me with instructions and a strategy of how to go about making the necessary changes to our accounts. Jim Collins has revolutionized my thinking and completely changed my investment strategy. I'm actually excited about this stuff now. A weight has been lifted and I no longer loathe investing. And I have a much better handle on how to optimize our taxes. In the last 4 months, we have rolled over 2 401ks into Vanguard IRAs and invested both in VTSAX. I am in the process of closing the high-fee brokerage account and will also be investing in VTSAX. I have stopped our extra mortgage payments, and that money is now being used to max out our Vanguard IRAs. By the way, my husband's employer, I found out, contributes 5 cents on every dollar that he contributes. That's a guaranteed 5% return on his investment. We are currently investing 10% of his income here. Once we have maxed out our Vanguard IRA accounts for 2018, we will go back and beginning adding more to his 401k since there's no cap on the employer match except that which is limited by the IRS. We are using Mint to track our expenses, Personal Capital to track our net worth, and have gotten the call, the Personal Capital call. Go you. I have also moved money out of a traditional savings account and have opened a taxable brokerage account at Vanguard, which is currently invested in VTI. This account is saving for my son's future wedding because I know that someday down the road, this big expense is likely to rear its ugly head. Or better yet, he too will be on the FI journey and opt for an inexpensive wedding, in which case I may gift them the account to seed their own journey to FI. That story is yet to be written and the options are endless. Speaking of my son, he is 22 and has saved 10% of his income since he started working and has recently opened his own Roth IRA at Vanguard and has invested it in VTI. In just a short time, all of our Vanguard accounts have shown significant gains. So I texted my son recently and asked him if he looked at his account lately. He replied, I thought the whole idea was for me to not look at it. He looked and bought another share. I can't help but smile. 4th generation fire has been sparked. Yes, I said 4th. My father and grandparents had been gone so long that I almost missed a piece of my history, but they all retired early and were financially independent until they passed. Each left behind a fortune in stocks and a legacy of financial immortality, but they lived so modestly, who knew? Unfortunately, following the recession, I have made numerous financial mistakes, all because I didn't know what I didn't know, which is why I'm so grateful to have found the ChooseFI community. Oh, how I needed this. I am now using credit cards to pay my utility bills and insurance and have incorporated the 72-hour rule into our spending and have met the minimum spend on my first Chase card. I have attended 3 meetups with our local ChooseFI group and have found priceless resources there as well. I am blown away by the spirit of helpfulness that I have found in my local community. Go ChooseFI Northeast Ohio. And since I will be traveling to Santiago in September, I hope to organize a meetup with the Chile group while I'm there. Thanks to your actionable tips, these are just a few of the things I have implemented to optimize our path to FI. Next up, cutting the cord with the Uverse and Verizon. At 54, I have made just about every financial mistake imaginable. While early retirement is likely out of reach for us, thanks to you, Brad and Jonathan, and the rest of the FI community, we will arrive in much better shape. Thank you for lighting our way down the road less traveled. Debt of gratitude.
Wow. I'm basically speechless. There's too much there to go through point by point, so I will not even try. But I loved when her son said, I thought the whole idea was for me to not look at it, right? Don't look at your balances, but mom's being the bad influence there.
Sounds like Anna. That's like something Anna would coach you on if you went to show her your monthly balance.
Seriously. But wow, 4th generation FI. That is truly remarkable. Shari, congratulations to you, your entire family for listening, taking action, and just remarkable. So thank you.
And Brad, something that we've been talking about a lot over the last year is this idea of multi-generational wealth building. But we've been kind of talking about it at a high level because, frankly, we're having to find out what are other people doing, and we're finding it out slowly. Things are coming on our radar through the Facebook group and maybe through anecdotal stories, but finding someone that is actually doing something is somewhat of a challenge, but it's so valuable. And what we're going to do today is talk with Chris from our Facebook group. Last year, he mentioned that he had started a family bank. And frankly, this is something that when you first hear about it, you're like, oh, no, you don't lend money to family. You don't do anything with family. That's just kind of the almost knee-jerk reaction. But there are people that are doing stuff with family, and it's actually a win for everybody involved. And so finding an example of that was something that I was really excited about, especially in the context of multi-generational wealth building. So yeah, I'm really excited about this.
Yeah, and that's funny that you talk about the knee-jerk reaction, because when you first told me about this in general, someone from our group is loaning a significant amount of money to family members, my reaction was, oh, wow, that sounds really crazy, but I want to learn more. I can have that old reaction, which is the old me, the closed-minded me, and still then say, all right, but who knows? I want to learn more. And I think that's why we're having Chris on the episode. So Chris, welcome to the show.
Thanks, guys. Really excited to be here.
So tell us a bit more about this idea. How did it start? How much money did you start with? What prompted this?
Well, the idea started with really an observation, which is in your family. When you think about your family, your extended family, you have a bunch of people in all phases of their financial lives. You've got kids. You've got people that are building wealth. You may have retired people that are spending wealth. All of those people typically have, different piles of money. So in addition to like official retirement vehicles, they'll have things like emergency funds and savings accounts, possibly excessive checking accounts, and et cetera, things like that. Many of these accounts are not making any money. And, when you look at an individual, maybe that's only 12, 14, 20,000. That's not making money. And that might be a small percentage of their wealth. But if you look at all your family members, so let's say you have a big family, maybe you have 35, 40 people, multiply that by $20,000 and you have a huge, huge chunk of money that's just sitting there not making any money. And then meanwhile, you have other family members that are taking out loans for cars and homes and things like that. And all of that money for the interest that they pay just to borrow that money goes outside of the family. It goes to banks. It goes to potentially credit card companies. It doesn't stay in. So there just seems to be a lot of waste. We looked at that and we said, we could probably optimize this. Basically, the family has a pile of unused money and not making a profit on it. And there are people that are borrowing money and paying for it, which is absolutely insane. So what we ended up doing with, and it really started with $100 because I didn't get buy-in on this idea. Plus, this idea wasn't completely clear about 15 years ago, right? So I didn't know how to speak about it to my family members. So what I did is I put $100 into an account. And for Christmas, instead of buying people presents, I gave them their first deposit to the account. And I got laughed at, but it slowly grew into what it is today.
So Chris, talk me through that. This first $100 deposit, I need some more clarification on how this starts and then where it goes from there.
Sure. What happens is everybody put their money into the same theoretical pot. And we created Google spreadsheets that were made available and totally transparent to everybody who did that. And then what I did kind of as a quarterback is I directed the money from family members who had it. So, hey, mom, you have an emergency account of $10,000 into, in an account that makes you 0.01% interest. Why don't you put that money in? You can take it out whenever you want. And then meanwhile, we can loan some of it to other family members that may need a car, may need to borrow it. So that's what we did. So again, slowly, but over time, it grew into a significant amount of money where multiple people could borrow larger chunks of money for cars, homes, things like that, and then just pay the family back at interest. Basically, the goal is to have virtually 100% of the money that's in the pot loaned out. So there's never an account with thousands of dollars in it. Everything is always loaned out to people that need it, and then they pay back money with interest, which immediately gets loaned out to other loans, always making what we have is we make about 6% total per year on interest for all the money. So we charge about 6% for all the loans that are out.
So Chris, you said you try to keep it 100% loaned out, but then when you were describing that conversation with your mom, you said you can take it out whenever you want. Talk me through the mechanics of how that would work.
Sure. This is actually easier the more people you have. So our bank currently has 17 people in it. So what happens is there's a lot of activity. There are several loans. There are people that are depositing money each month. So if you break it down each month or 12 times a year, there is money coming in from loans. There's money coming in for deposits. And then at the same time, there are people that need money. They're taking out loans. So basically the money comes in and immediately it gets loaned out to the next person that needs it.
That's very cool. How do you determine, so someone needs it, they're going to buy a car or a house, not to get too private here, but do you vet what these cars and if someone wanted to come in and buy a $100,000 Porsche, do you just say, okay, that's great, here, just pay me my 6% interest, or do you actually look into what they're purchasing?
That depends. So let's say that you want to buy a $100,000 Porsche and you only have $2,000 in the bank. So at that point, yes, I would absolutely make a judgment call and say, sorry, you have $2,000, you're trying to borrow $98,000. It's just not going to happen unless another family member or multiple family members are going to guarantee the other $98,000, basically a co-signer for your loan. If no one's willing to do that, then you're not getting $98,000 or the $100,000 for your Porsche. However, if you have $100,000 in the bank and you want to borrow $100,000, there is no questions asked. You get it because you have that amount of money.
Chris, let's talk about documentation. So you mentioned there that you would essentially be able to have a parent or a relative co-sign on the loan to guarantee this. One, what if they don't pay? What does that look like? And two, I guess, have you had any examples of anybody not paying? And then three, what documents do you have?
So actually, this bank has existed for about 15 years, probably 7 or 8 of those years. Just the most recent ones are probably where the money was big enough that, where we could actually call ourselves a family bank. Before that, it was really pretty small. But once it got going, or even from the beginning, there has never been someone who didn't pay, which is kind of surprising because you have a lot of people, you have family, and everyone's paying their loans, which kind of sounds ridiculous. But part of that might be because we make it pretty transparent. Who's borrowing money, how much they're supposed to pay each month. And also we guarantee the money too, which means that if you have 10,000 but you want to borrow 20, someone has to guarantee the other 10. So if you didn't pay, say you borrowed the 20,000 and you said, you know what, I'm taking a vacation, I'm not paying you guys back, I'm going away. somebody guaranteed the other 10. So the first 10 is yours. Then, we just take that money out and say, okay, well, you just took out, your own money, $10,000. And then the other 10, somebody guaranteed you. So let's say your brother guaranteed you 10,000. So he's out 10,000.
And can I hop in and say you're guaranteeing that with money that's in the family bank already? So it's
absolutely.
Okay. That makes sense. What about documentation?
We don't do any documentation really. I mean, other than Excel spreadsheet as far as how much you've taken out and who it's guaranteed by, there's no official signing of a contract.
Wow, that's amazing. So this really works through goodwill and through family ties.
Exactly. Somehow it all works pretty well.
That's amazing. So just real quick, what types of loans are in actuality like right now? Are there mortgages? Are they mostly cars? Are they personal loans? Talk me through what you see today.
Actually, we don't have any cars at the moment. Right now, we have 3 mortgages and we have 6 personal loans.
Let's talk about the mortgages. So if I were to go as a W-2 employee to go get a rate, from a bank, I think you could probably still get around 4%, but your rate is closer to 6% right now. What are your thoughts on that? Are they getting a better deal somehow? Is there some extra incentive for them to use the family bank as opposed to just going, or is it because their credit isn't as good? Like, what's going on here?
So there's 2 parts. This is a 2-part answer. One is no one actually has a mortgage that they're paying off for their primary residence. All of the mortgages that are in here are for investment properties. And if, as you know, if you buy an investment property that you're not living in, your interest rate is higher than what you're seeing for mortgage rates, the 3 and change, or I think right now they're low 4s. So it's a little higher. So potentially by paying 6%, you could be saving money.
So you're competing with a hard money lender at this point?
Yes.
Very cool. You said it was a 2-part answer. What's the other part?
All right. Then the second part is they are paying 6% interest. In our case, we do 6%. So they're paying 6% interest. However, some of that interest goes right back in their account. So for an example, if you have 25% of the funds that are in the bank, 25% of the interest that you pay each month is actually going to go right back to you. So you're getting a 25% discount on that 6%.
It's so freaking cool. I love this idea, man. So I may be a little bit naive in thinking that everybody will just work together. But and while I can understand this idea of dealing with family and when something goes wrong, it just all falls apart. In the context of a first, second, and third generation FI conversation where everybody has a similar mindset, they're operating from a strong financial ground game. People need money at different places. And right now, the interest is just being lost to some vague third party. What if you could have this utopian society where you were able to keep everything in the system and it were just able to benefit people in different stages of life? Like, Brad, I'm thinking about Anna and Molly. At different points in life, there is a likelihood that they are going to take out some form of a loan, albeit for a car or a mortgage. What if there was a way to help each other? And I think that, to me, that wouldn't scare me. If I was talking about doing something with my son, I would love to help him, and I would love to do it in the context of a family bank. I would be incredibly open to that idea.
Yeah, it is interesting. I obviously never thought of this before, this 15-minute conversation, but yeah, I'm more open to this than I would have thought, I have to say, Chris. I'm very impressed with this. I have a bunch more questions, if you don't mind. Where does this go from here? So obviously, ideally, you want all this money invested in the family and the guarantees are essential, but there might get to be a point where you have way more money in this account than you could ever loan out for random cars and personal loans. Have you guys contemplated investing the money outside of the family in any manner? It doesn't have to be loan. It could be buying property. Like, has that ever crossed your plate yet?
Yeah, and there's a lot of directions that we can take this in the future. What I'm envisioning, and this may happen or may be totally different, but what I'm envisioning is that because this continues to grow, not only the funds, but also the people that are in the bank, that the funds are going to be significant enough where several family members can get together and say, hey, why don't we, if it's real estate, why don't we buy a 20-unit building where it's a significant amount of money? Well, now there's this sort of vehicle where there's money to potentially invest rather than, if you don't have this visibility to how much people have and what is the pile of money as a family, you don't know. And you'd have to try to call your uncles and your brothers and be like, hey, how much money do you have to invest? Hey, would you want to do something like this? This is so transparent where you can see all the balances and you can see what people have. And then immediately, whether you're either in the ballpark or not to buy a car wash or to buy a real estate property or to buy a McDonald's, whatever it may be. So I think that it's just the transparency provides the opportunity to work as a family to invest the money in different ways.
Do you think that having something like this family bank, actually makes the family as a whole more financially responsible as you move from consumers to owners?
So I think it's less about being responsible, but what it does do is because we have to discuss finances constantly amongst family members, it does bring the family closer. And maybe you'll do less stupid things just because everyone might be more aware of it than you would in a regular sort of financially siloed family. But I don't think that this alone would make someone more responsible financially.
Chris, when I asked that question about possible future investments and buying a car wash, you said, or buying whatever it may be, it leads to my next question, which is about like the decision-making process. Is there someone who is in charge of this? Is that you and you're making all the decisions? Is it weighted by the percentage of assets you have in the total fund and you get that percentage of voting? It sounds like everything's worked pretty smoothly. You come, you ask for a loan. If you have the assets, then you get it, no questions asked. If not, you need someone to guarantee it. I get that conceptually, but going forward, it sounds like there's potentially more of like a decision-making process. Have you thought about how that'll work?
Currently, it's pretty easy because we have anywhere from maybe 7 on a low month to potentially 25 at a high month, 1,000 coming in. So between 7 and 25,000 coming in every month from loans and deposits and things like that. So when someone needs to borrow money, it's usually in the $5,000 to $15,000 range, unless it's a mortgage. So these decisions are actually really easy because we don't necessarily say no, just say, well, we can't do it this month. Can you wait 2 months to do this? And that has never been a problem so far. And again, the more people that you have, the more people will be asking, but then also the more money you have every month to distribute to the loans. So the decision process is actually pretty easy.
So Chris, you said, you've been quarterbacking this thing for a while, and I would imagine that you have a substantial percentage of the invested assets. How does this change your investing strategy?
So my investing strategy is actually pretty cool. Right now, I'm invested in 3 main categories, and this family bank is 1/3 of my investment strategy, which is basically money being loaned out and it's making 6% a year. Then I have, of course, my traditional 401k with my job, which is about 1/3. And then the rest is in real estate equity, rental properties. So I have a really kind of nice balanced portfolio with 3 different things because it doesn't matter what the market's doing. Even if the market does really poorly, that doesn't affect the family bank.
How does this change your allocation on your investments in like your retirement buckets?
I am 100% invested in stocks. I thought about doing the regular allocation where you're partly investing in bonds, but I treat the family bank as my bonds basically, except getting traditionally a higher rate of return on the family bank than I would with a bond market.
All right, Chris, so we're always looking for actionable tips. If someone wanted to start this, if they said, wow, this sounds really interesting, how would they go about it? What do you suggest as far as that Excel sheet, as far as bank accounts? How do you even broach this subject with your family without being like the weird Uncle Chris who's bringing up some bizarro financial thing? How does this...
One day you're going to come to me and you're going to ask me for a favor.
Exactly.
I couldn't resist.
Too easy. But yeah, Chris, talk us through that.
That can be really hard. And it also depends on your family dynamics. Are you talking about money now? I'm familiar with families that never speak about money. The kids do not know how much their parents make. The aunts and uncles have no idea how much the family makes. So I think it was a little easier for my family because we were a little bit more transparent about that. So starting that conversation for us maybe was a little bit easier. It's really finding at least one or two people inside of your family that are open to this idea of grouping funds together to then take loans from them. And as long as you get a core group and a significant amount of money, and when I say significant, I'm not saying hundreds of thousands, this could be $20,000. Other people are going to want to know more about it. And they're going to start asking questions. They're going to become interested, and they're going to ask you if they can be a part of it. This may not happen overnight. It took years for our family to really all buy in and extend to, family, friends, extended family, and such. So I think just getting the conversation started with anybody that's open to the idea, and you will see it organically grow, and people will become interested in it, and people are going to want to be sort of members of this family bank. And it's going to grow and change and evolve as there's more money and as there's more people.
Chris, have you thought at all about like the tax implications of making this interest on this substantial sum of money?
We did. I wanted to make sure that what I was doing was legal. And when it comes to money being lent to family members, or even friends for that matter, as long as you're staying under the threshold for how much you're making off of interest, there are no tax implications. You do not have to report it. The last time I checked, this was $7,500. But I really hope that the people that are listening to this, maybe an accountant in your team, can come back and clarify exactly when this becomes too big to be an unofficial agreement between family members. So I'd be really interested to hear what people with knowledge in that field have to say.
All right, Chris, well, you are in luck. I went ahead and I took this idea and I ran it by our accountant here at ChooseFI, Shane Mason. Now, Shane is a CPA and a CFP, Certified Financial Planner. You can find him at shanemasоncpa.com and brooklynfi.com. And he has agreed to help us out from time to time if we get listener questions that really need someone to dig into the nuances of things that you should be considering and kind of give some expert insight. So I have a feeling he's going to be a little bit skeptical. Let's see what he has to say.
All right, Jonathan, sorry this is late. Here are my thoughts on the family loan, or the family bank, I should say. First of all, let's not talk technicals. Let's talk about personal feelings about it, because everyone has their own anecdotal feelings. My family specifically has had a fallout with money that resulted in 20 years of bad blood. I'm sure a lot of families have had that, especially bigger families. I know that was a lot of the caveats that Chris spoke on. But money in family is dicey, and you want to love your family and use money. You don't want to go the other way around. And sometimes that's hard to do. Some other thoughts is that, treating your family bank as bonds in a portfolio, I'm really wary of that. Bonds are typically owned by corporations, big public companies that don't have much of a chance of going out of business. And then there's government bonds as well. And then I would recharacterize the family bonds or the family loans more as junk bonds. Even, smaller corporations will qualify as junk bonds. People do not weather as well in downturns in the markets as well as corporations do, unfortunately. So using the personal loans as a ballast instead of corporate bonds, government bonds, or even high-ranked junk bonds is not the same thing. Not the same investment strategy. I'm not an opponent to 100% stocks. As a CFP, I am personally mostly stocks. Another thing to keep in mind is, why not just go to Lending Club if you're trying to include some personal community loans into your investment portfolio? I understand that your investment portfolio and maximizing the returns on it is not the purpose of the family bond or the family bank. It's keeping things within the family. But those are just some thoughts that I had on that. Now, on the technical side, this is a nightmare waiting to happen, perhaps. I never heard anything about what type of entity this is. It has to be an entity because You guys are pooling money, so you're effectively going into business together. So if you go into business with somebody and you never sign an agreement, there are certain provisions of the law that say that you are effectively a partnership or a joint venture. I'm not an attorney, but I think that would be one way that this is interpreted by the IRS. And the way that the IRS is going to interpret this is always going to be, it's not always going to be the way that you want it to. And the reason that I'm saying interpret is because there's no paperwork. And if there's no paperwork, then all the IRS can do is interpret these things. One thing that I'm really worried about is the fact that there are no contracts written between the family members, which, while Chris did say that there is, that's nice that there are no contracts because that provides maximum flexibility, which is really great for family members where there's a lot of trust. If you want to avoid having to charge a floating rate, maybe I should back up on the way that the interest works between family members. There is the possibility of charging extremely low rates to family members, lower rates than the market rates. That is possible only for family members. There's a concept called the AFR rate, which the IRS issues, and it's usually much lower than the prime rate that banks are going to charge you. And you can use AFR rates between family members as long as there are certain terms within the contract. And if you're telling me that there is no contract, then you're not going to be able to use those terms. So I would start using contracts if you're going to do this in the future. The second thing is that interest income is always going to be taxable income. That is because interest expense is an expense. So the family members are likely going to be using or you would like them to be able to use the mortgage interest, or if it's a mortgage, or if it's an interest on an investment property, you would want them to be able to take the interest that they're paying as a deduction. Otherwise, the value of these loans goes down if there's no tax deduction related to it. Just look at the way that the stock market, or I imagine the real estate market, is going to be impacted a great deal by the fact that mortgage interest with the new tax law for individuals has been cut, has been limited, and standard deductions are expanded. But that's a topic for another podcast. So I think that's going to be reflected in the prices of homes. So if your specific interest doesn't provide for deductions within the family bank, then they're less valuable to the people taking out the loans, even though they're at a lower interest rate. So it's a give and take. And the reason I'm mentioning interest income needs to be picked up is that who is picking up the interest income? Is it the entity that has not been established? Or because if everyone puts $100,000, let's say everyone in the family, there's 4 family members, and they each put $25,000 into the family bank, and then a loan goes out to a 5th family member. Well, whose money was lended? Was it, money is fungible. So which means that it's all the same once it goes into that pot. So who is making the loan? It should be the entity, in my opinion, which would be a corporation or a partnership. If it's corporation, we have to worry about the personal holding company tax. And if it's a partnership, we have to split up the profits, and they would all flow through to the members of the family bank. You had mentioned at some point during the explanation that, yes, you are lending money to yourself. Because if you are one of the 4 people that put in $25,000, you take a loan for $30,000. Well, and you're paying 6% on that loan, and you're paying 6%, but you're paying yourself essentially because you are an owner of that entity. Well, imagine a tax return wherein you have taken a deduction for mortgage interest from the family bank, and it discloses that bank on the tax return. And then on that same tax return, it has the name of the bank as income on a separate schedule. Imagine an IRS agent, which, they don't look at every return, but if they were to look at that tax return, how you would try to explain that you are making a loan to yourself and you're taking a deduction and then picking up income on that return. Typically, IRS agents, they do not want to get terribly creative with you. They don't look at things and say, "Oh yeah, I see what you're doing here. That's chill." They're very busy people, and they get paid based on how many cases they can close. And if they have an opportunity, and how many cases they can get off their desk as fast as possible. So if they have an opportunity to say no, they generally say no. And then they move on and they let you fight it. And it's going to be a big pain in the butt to move beyond that. So absent the total lack of a entity here that would be picking up that income, those are some of my biggest issues. You guys, I think, need to speak to an attorney and an accountant, preferably somebody that is familiar in both spaces. If you really want to take this family bank to the next level in terms of, I dig it. I really like it. I would love to have a family bank between me and my 3 sisters. We trust each other a great deal. They're out there paying mortgages to banks that do God knows what with the money, getting bailed out with that money. I would prefer to keep it within the family myself. And maybe I'll explore that, but I'll let you be the vanguard of sorting out the legal and fiscal and accounting issues with that. And I appreciate the idea.
Wow, Shane, that was awesome feedback. Thank you so much for kind of filling in the details there. Certainly a lot to consider and not something to do lightly, a lot of risk. But I love at the end that you said that, if you know how the rules work, it's something that looks like it could work. I think that this is going to be a recurring segment. I have a feeling it's going to kind of blow up as we really start to polish it and kind of figure out the parameters of what we can accomplish with a segment like this. We need to come up with like a grading system for all of these crazy ideas that we're going to get over time. Like, if a 10 is just the most brilliant idea ever that everybody should be doing, like, I don't know, rental real estate or house hacking or something like that, or the mega backdoor Roth, there needs to also be the ideas that are just like total bombs, right? That everybody should avoid them. Nobody should go near it. We need to come up with some sort of metric to kind of grade these things. And it sounds like this idea scared the crap out of you, but at the same time, piqued your interest. I'm going to throw one more out there for people that I'm going to talk about in a future episode. Someone already has polished it up and made it more viable and taking care of all the reporting in the accountant, and that is the family mortgage. I'm just going to leave you that teaser right now. We'll come back and we'll talk about that in a future episode. But to everybody that was involved in putting this together, this was a lot of fun. I hope it was valuable and entertaining for you as the audience on your commute to and from work. All right, my friends, unfortunately, that is going to bring this episode to a close. Now, as you know, we like to finish every episode by doing a drawing for a copy of a book that we have found useful. And there's 3 books that we offer. The first book is J.L. Collins' book, The Simple Path to Wealth. The second book is Dominic Cortuccio's book, Design Your Future. And the third book is Vincent Puglisi's book, Freelance to Freedom. If you want to enter the drawing, all you need to do is just go to ChooseFI.com/iTunes, follow the instructions there, and leave us a short written review, and then send us an email to feedback@ChooseFI.com, letting us know that you left a review and what screen name you left it under. We give away 1 book for every 5 written reviews that we get, and then we announce the winner on the Friday roundup. And Brad, how many winners do we have today?
All right, Jonathan, we have 1 winner.
And the winner is Lisa. And Lisa says, my brain is on fire. I'm just over 30 and new to all things FI, but I have been binging on this financial podcast as a favorite. I like how there's Brad as the more conservative personality. I mean, if he says it's a good idea, I can trust him, right? But also the balancing personality of Jonathan, the reluctant frugalist, like me, to make me believe that I can actually achieve the goals they talk about. Since I started listening, I've upped my retirement savings contributions at work, reassigned all the automatic high-cost 401k assignments to low-cost index funds, refinanced my student loans, paid off my car loan, started actually tracking my spending, cut my grocery bill, opened my first travel rewards card, started a blog, cut off, well, mostly, my expensive diet Pepsi addiction, and ordered a Simple Path to Wealth at my local library. Thanks for all you do. And thank you, Lisa. That is incredible. Congratulations on what is absolutely massive action. All right, my friends, take action in your lives this week. The fire is spreading. We'll see you next time as we continue to go down the road less traveled.
You've been listening to ChooseFI Radio Podcast, where we help middle-class America build wealth, one life hack at a time.